If I asked you what caused the 2008 financial crisis, you would probably give me the standard answer. You would say it was greedy bankers. You would say it was subprime mortgages. You would say it was a failure of regulation in the early 2000s. And you wouldn't be wrong, exactly. But you would be looking at the symptoms, not the disease. To understand why the modern consumer behaves the way they do, looking at the year 2000 is useless. This isn't a story about banking. It is a story about World War II. It is a story about a massive psychological experiment that started in August 1945, and how it rewired the brain of every single American consumer. In his book The Psychology of Money, author Morgan Housel explains this brilliantly. His thesis is simple. To save the economy in 1945, we engineered a culture of debt. And 2008 wasn't an accident. It was the mathematical inevitability of that culture hitting a wall. Let's go back to August 1945. The war ends. Japan surrenders. The New York Times called it the happiest day in American history. But as Housel points out, that joy was instantly met with a terrifying question. The question was, what happens now? 16 million Americans, that is 11% of the entire population, were coming home. Their average age was 23. They needed jobs. They needed lives. But there were no jobs. The factories that were building tanks and planes stopped overnight. Economists were terrified. The Council of Economic Advisers warned President Truman that the country would slip back into a full-scale depression within 4 years. And it wasn't just jobs. There were no homes. Construction had ground to a halt during the war. In 1943, fewer than 12,000 homes were built in the entire country. Returning soldiers were facing a homelessness crisis. So, the government did something radical. They decided to re-engineer the economy. They needed to turn a generation of Depression-era savers into consumers. The only way to do that was to make debt incredibly cheap. Tool number one was interest rates. The Federal Reserve kept short-term rates at 0.38%. They didn't budge a single basis point for 7 years. Suddenly, borrowing money wasn't expensive. It was practically free. Tool number two was the GI Bill. This gave 16 million veterans unprecedented mortgage opportunities. Zero money down. Low fixed rates. Buying a home actually became cheaper than renting one. Tool number three was the invention of modern credit. The first credit card was introduced in 1950. And get this, interest on all debt was tax deductible at the time. As Housel puts it, it tasted delicious. So we ate a lot of it. The plan worked perfectly. Home ownership skyrocketed. From 47% in 1900, to 53% in 1945, to 62% by 1970. A new cultural norm was born. This kicked off the golden era of the 1950s. You had pent-up demand from the war meeting easy credit. Appliances, TVs, homes, America went on a buying spree. The numbers were staggering. 21 million cars were sold in just 4 years. By 1955, another 37 million was sold. Factories were humming, and jobs were plentiful. But here is the most important part of the story. This wasn't just a boom for the rich. It was a boom for everyone. Average wages doubled from 1940 to 1948, and then doubled again by 1963. The gap between the rich and the poor narrowed significantly. The top 1%'s share of national income actually dropped from 13% to 7%. The country got rich by making the poor less poor. This created a fascinating psychological effect called lifestyle equality. Harper's Magazine noted in 1957 that the rich man and the poor man smoked the same cigarettes and drove cars that looked pretty much the same. People measure their well-being against their peers. And for 30 years, most people lived lives that were understandable to their neighbors. The expectation was set, I should be able to have what he has. But then, the music stopped. In 1973, inflation spiked, unemployment rose, and the economy shifted gears fundamentally. The era of shared prosperity was over. When growth returned in the 80s and 90s, it looked very different. It was uneven. Between 1993 and 2012, the top 1% saw their incomes grow by 86.1%. The bottom 99%? Just 6.6%. Here is the trap. The economy had fundamentally changed, but our psychology hadn't. We still held on to the post-war expectation that we should live like our neighbors, even as our financial realities drifted apart. Housel gives a perfect example. Consider Joe, an investment banker making $900,000. And Peter, a bank branch manager making $80,000. In 1950, these two men would have been peers. Today, they live in different universes. The gap between their incomes is massive. But Peter still sees Joe. And that is where the psychology kicks in. He sees the 4,000 square foot house. He sees the Mercedes. And because of that 1950s psychology passed down from his parents, Peter feels a subconscious entitlement to live a similar lifestyle. So what does Peter do? He can't afford Joe's life with his salary. So he uses the tool the government gave him in 1945, debt. He takes out a massive mortgage. He leases 2 cars. Housel calls this the big stretch. Look at the data. Household debt to income was stable at around 60% for decades. Then, starting in the 70s, it climbed and climbed, hitting over 130% by 2007. We were stretching to buy fantasies. Even as families got smaller, homes got 50% larger. The number of homes with 4 or more bedrooms went from 18% to nearly half. We were buying empty rooms on credit just to keep up appearances. It was cars too. The average car loan, adjusted for inflation, more than doubled between 1975 and 2003. We were spending twice as much money just to get from point A to point B. Economist Hyman Minsky described this perfectly. He said stability breeds instability. There is a Minsky moment, the exact second when people take on more debt than they can ever pay back. Housel compares it to Wile E. Coyote running off a cliff. He keeps running on thin air, smiling and confident. He doesn't fall until he looks down. 2008 was the moment we looked down. So, 2008 wasn't just a banking error. It was the snapping point of a 60-year psychological experiment. The debt bridge we built to cross the gap between our income and our expectations finally collapsed. And what happened next explains the world we live in today. We bailed out the banks. We printed money. We cut taxes. But Housel points out that these measures largely benefited the people who owned assets, the rich. The recovery widened the gap even further. The Peter class, the middle class, got left behind. The post-war promise that hard work equals a good life felt like a lie. This is what fuels modern political rage. Whether it's the Tea Party, Occupy Wall Street, Brexit, or Donald Trump. It is millions of people shouting, "Stop the ride, I want off." And then you add social media. Now, we don't just suspect our neighbors are doing better, we see it in 4K resolution on Instagram every day. As Benedict Evans says, the more the internet exposes us to other views, the angrier we get. So, what is the lesson? Housel concludes that expectations move slower than reality. We are living in a 2025 economy, but we are still operating with 1950s expectations. History is just one damn thing after another. 1945 led to the boom. The boom led to the debt led to 2008. And 2008 led to the anger we see today. If you want to understand where the economy is going next, don't just look at the interest rates. Look at the psychology. Look at the ghosts of 1945.